They are calling it the coronavirus stock market rally, and on Tuesday, the S&P 500 index and the NASDAQ hit all-time highs. So in the middle of a pandemic with so many people out of work and the economy struggling, what's behind it? Here to answer that question is our money expert, Bruce Allen of Bruce G. Allen Investments. He's joining us by Skype. Good morning, Bruce.
Good morning, Gary. How are you doing?
I'm doing well, thanks. Good. So what's fueling the stock market rally?
In the last 4 months, since March 23rd, when since the market has risen dramatically, what we've seen is that this market rally has been driven by very large growth stocks, especially in the technology area. And it's about 10 to 15 stocks that have really led the charge. These stocks are now getting very expensive, and it's really focused this rally on a very few number of stocks.
So why are these companies doing so well, do you think?
Well, I think there's a couple of things. One is that they were doing well, and there's a theory on Wall Street that suggests that companies that do well will continue to do well. It's called momentum trading. That works until it stops, and when it stops, the dance is not pretty when it ends. Secondly is there's a legitimate reason why many people, given that we had shelter-in-place orders, are using more technology to shop, access friends, talk to people at work, things of that nature. So many of these technology companies have seen their revenues and income rise during this pandemic.
So what are the companies kind of that we're talking about? I'm guessing Apple is one.
Yeah, I think that the focus really has been typically FANG. So Facebook, Amazon, Netflix, Google, Apple, and Microsoft. And those stocks are up dramatically this year. The top 5 of those companies now represents the largest concentration in the S&P 500. And we should say, Gary, this is not a recommendation to go buy these stocks. Why? In the past, when the market's gotten this concentrated, the companies that have caused this kind of concentration typically have very difficult environments over the next 5 to 10 years in terms of performance. So people need to be very cautious about chasing these names at this point.
That's pretty interesting. So with so few companies driving the market and losers outpacing winners overall, is this rally sustainable, do you think?
Typically, when this has happened in the past, Gary, it has never been sustainable, and typically we see significant declines in not only the companies that cause this concentration, but we also see markets decline fairly substantially as well. Happened in the mid-70s, the market went down dramatically after that, and those companies that were in that concentration in the mid-70s had very difficult environments over the next 5 and 10 years. Most notably, what you and I both lived through recently was the tech bubble. And the companies that caused that market increase in the last 2 years of the 1990s, they had very difficult performance over the next 10 years, meaning the companies did very poorly in terms of performance, and the market itself fell dramatically. So these are not things that happen at market bottoms. They are things that these are phenomena that happen at market tops.
That's pretty interesting stuff. All right. Well, thanks for clearing that up, Bruce Allen. We always appreciate it.